Welcome back, students, to our new lecture on chapter number 9. This is our new chapter. Chapter number 9 is about responsibility accounting. Now, as we know, what is responsibility? Responsibility means taking care of something, taking responsibility. Now, what is responsibility? Right. Remember that effectively, normally, basically in accounting, responsibility accounting, it requires clear line of authority and responsibility. Right. Now, I can give you an example. Right. For a small business, an owner can make a decision about many things. What to sell. For example, what to produce, even he is responsible for accounting, right? But for a large organization, one person cannot do all these tasks. So you have to divide these tasks among many people. Imagine you are a CEO of SABIC and you have to manage maybe more than 100,000 employees or around that number of employees all around the world. So it is very difficult to manage each and everything on your own, as compared to a small firm, small business, maybe 2 or 3 employees operating in one location. It is easy for such a person to manage this one. Now, for example, hiring an employee. In a small business, an owner can make a decision of which employee to hire, right? And what is, for example, what should be his salary and how to hire him, right? So, as compared to SABIC, when you have to hire an employee, for example, as a president of a company, it is impossible for you to make such decision of hiring an employee. So what normally we do in large organization is that you delegate this authority to a professional person, HR manager, a professional HR manager, right, and hold that manager responsible for hiring practices, right? So this is what we call it responsibility accounting. Okay. Now, to start our chapter, we have the very basic concept, which we call it decentralization. That what is a decentralization? Now, decentralization is a very important concept, right? Basically, what it says here, that you delegate authority and responsibility to someone. This is what we call it decentralization. And decentralization, it offers many benefits, right? What are the benefits of decentralization? For example, upper level management, they can concentrate on strategic level decisions as compared to hiring an employee. For example, it is a routine decisions, right? So we'll continue on our next slide, responsibility accounting. Just what I've said before. What is responsibility accounting? It is an accounting system that provides information relating to responsibilities of the individual managers, right? This is what we call it responsibility accounting, that what is his responsibilities, and then you evaluate his performance on items which are controllable, right? What are the controllable items for that manager? You make him accountable, whether he get a credit or he get a blame. So it is then how we will see it in responsibility accounting. Okay, so accounting system basically that assign responsibilities and make those managers accountable for their responsibilities, right? So now, very important concept in this one is that controllable costs are clearly defined, right? clearly defined, and then we evaluate those performance based on that manager's ability to control those costs. Then you can compare what was the budget, what is the actual performance. You can go back to the previous chapter and see the same concepts which we have seen in previous chapter. Now we are continuing those things into a further level by establishing our responsibility. Now next concept which we discussed earlier as well is a decentralization. Right. Now decentralization, as I said earlier, right, is delegating authority and responsibility. Decentralization, delegating authority and responsibility. Why we delegate? Why we don't do all things by our own? Of course, we are human beings, and for a large organization it is impossible to do all the tasks, for hiring to operations to discounts to production. It is impossible. So you need to delegate the authority to someone through decentralization. Okay. Now, what are the advantages of decentralization? First one is it encourages upper level management to concentrate on their strategic decisions. Right. Now, lower level management, they can do those routine decisions like hiring an employee, right, or what should be the discount, right. And upper level management can concentrate on long term planning, means which market to enter, for example, which product to focus on, what are the other competitors doing, what should be our strategic directions. So they should be spending their times on these things rather than spending times on routine things. Okay. Also, it improves quality of decisions making as well in an organization. How? When you have when you authorize lower level management to make our decisions, because they are the one who knows for example their areas very well, right? Why? Because they are the better informed. Recruitment manager is well informed about recruitment practices. Production manager is well informed about production practices, new technologies. So they are the one who are in a better control of understanding the things. So this is one. Second advantage is also it improves the productivity. How it improves productivity? Now, when you have a freedom to act, right, you can take an action, but with responsibility. In this kind of environment, when you act with responsibility, right, this basically results in an environment where individuals are encouraged to perform at a high level. This is what we call it, increase the productivity, or efficiency will be increased. Also, you can develop your lower level managers. Yeah, right. You basically train your lower level manager for increased responsibility. And as we know that decision making is a skill. So once they make a decisions, they trained in this one. So basically, then those employees, lower level managers, when they promoted to upper level, they are already trained in decision making. So you have already trained employees to make decisions. Also, it improves the performance evaluation as well, right? How it improves performance evaluation? This one here. How it improves a performance evaluation, right? When lines of authority and responsibility are clearly defined, right? So we know who has to take a credit and who has to accept the blame as well. So in this case, you can easily evaluate the performance of a person. You know how to evaluate them. all items are under their control. If they achieve it, they get a credit. If they don't achieve it, they get a blame, right? So that's how the performance evaluation is improved. Again, you need to go back to the previous concepts which we learned in chapter 8 about flexible budgets and standard budgets, right? For example, what is the budget, what is the actual, and you compare, and then you have to evaluate those variances, right? So now, what is a decentralization? This is just an example here. The basic thing in a decentralization, to understand any organization, how much they are being decentralized, their organizational structure, how many layers they have, right? So in this case, you can see here, in this example, you have a top management, you have a middle management, and then you have a supervisor. So here decision making is pushed down, right? Middle manager is not responsible for making each and every decision. Some of the decisions are delegated to supervisors, right? So decision making basically is pushed down. This is an example of a Panther holding company given in our book as well, right? That they have different lines of responsibilities. You will see here also in more detail one example of in our book, right? Page number, this is exhibit 9.1. It is an organizational chart given there. Yes, welcome back. Actually, this is just an example of structure of organizational structure of SABIC. This is also an example for us to understand that how a large organization can be run through decentralization. Here you can see here that in this organizational structure of SABIC, there is shareholders, board of directors, vice chairman, and CEO. He cannot do all these things on his own. So what they can do is they can assign managers, right, for chemical unit, for polymer, for some other performance chemicals, for metals. We call them strategic business units, fertilizers, for innovative plastics, for manufacturing, and some other units. So they are responsible. Here, let's say the president of SABIC Chemical is responsible for revenues, how much sales he made, what is the cost. At the end, he is accountable to the top about the income. He has the target for income or profit for each period, which he must be, his performance will be evaluated based on what was the target profit for him. So it means he is responsible for what sales he should make, what effort he should made about sales, as well as the cost. So he is responsible for both sales and cost. This is just an example of organizational structure of SABIC. Now coming back to our example in the book, which is an organizational chart for this Panther holding company on exhibit 9.1. You can see here they have 1, 2, 3, 4, and 5 levels of responsibility centers, right? There are 5 levels of authority and responsibilities, right? There is a lumber manufacturing, home building, furniture manufacturing. Let's say we go further down into furniture manufacturing. They have a carpet company, a sofa corporation, and table incorporated. Now under, let's say, table incorporated, we're just going deep into this one. So we have a sales department, we have a production department, planning department, and accounting department. Then under a production department, we have cutting department, assembly department, and finishing department. So this is what we call it a responsibility center. right? So these responsibility centers, right, are responsible for their, so these are the responsibility center. They are responsible for their cost and revenue, right? So if someone is responsible for cost and revenue, so at the end they will be evaluated based on a net income or a net profit. Okay, moving to our next slide, responsibility center. Now those responsibility center basically can be subdivided into three categories. We call them investment center, profit center, and cost center. Now a cost center basically is a unit which is responsible for costs. Sorry, I'll go back. Yes. Right. So cost center basically they does not generate any revenue. Right. For cost center they only make a cost. There is no revenue for them. For example, here let's say finishing department. This one, finishing department or cutting department, they are not selling anything, right? They are only responsible for making costs, right? So cost center normally, cost centers normally are at the bottom of the organizational chart, right? Now manager of finishing department or a cost center, basically he will be judged based on his ability to keep the cost down, right? So this is how he will be evaluated, right? He will be evaluated for keeping the cost down, right? Similarly, we have a profit center, right? A profit center basically is different from cost center. Profit center is different from a cost center, right? It not only incurs cost, right, but also responsible for generating a revenue as well, right? Now in our example, right, if I go back and show you, for example here, let's say this one, sofa company as an example here, or table incorporation here, this company, they are responsible for not only cost, right, they are responsible for revenue as well, how much table to be sold and how much cost incurred on making those tables. So manager of a profit center is responsible for both revenue and cost, right? So this is, you can see this is a third center, third level. This is first parent organization, this is second level, and this is the third level, right? So tables, which is part of a furniture business, right, they are responsible for their revenue and cost both. So manager of a profit center, this one, right, let's say, or tables incorporated, right, he will be judged on his ability to produce a revenue in excess of cost, right? What is the revenue he is generating should be more than the expense, right? So again you have to compare with his budgeted revenue, budgeted expenses, and is it favorable or unfavorable, you have to see, right? Now next topic, the next responsibility center is the investment center. Now manager of responsibility center, manager of investment center is responsible for revenue, for cost, as well as profit. What do you mean by profit? At the end, when you have a profit or earnings, you can invest it, right? In the profit center here, you are not going to make that decisions whether to invest or not. You just return that profit to the parent company, to the headquarter. But in investment center, you are responsible of making decisions about investment, right? What are the decisions about investment? If you have a profit, whether to establish a new plant, open a new branch in a city from that profit. So this is what we are going to do, right? So if I go back and look at our example, so this furniture manufacturing division here, this one is a investment center, right? So they are responsible for revenue, cost and profit as well. Whatever profit they have, they can make a decision whether to start a new line of a business, right, based on the profit they have generated or not. So they are responsible for both investment, right? So manager of investment centers are accountable for assets, liabilities as well as earnings. He is responsible for everything. Okay. So just to summarize, responsibility centers can be further divided into three: investment center, profit center, cost center. Manager of investment center is responsible for revenue, expenses, liabilities as well as earnings or profit. Profit center, here the manager is only responsible for generating the profit. That's it. He is not responsible for investing that profit. Cost center, manager is only responsible for only generating the costs. Just spending money is a cost center. Yes. Now responsibility centers are done. We'll move to next slide, which is about responsibility reports. Now responsibility report is basically prepared for each manager who controls the responsibility center, right? Now who controls the responsibility center? Again, if you go back to our same example about this Panther holding company, right, as you can see here, right, this is a furniture manufacturing division. What is their performance? We need to have a report about a manager, about what is happening overall in the company, what is happening here, or what is happening in this department. So any report which provide us this detail will be our responsibility reports. So preparing budgets for each of those responsibility center, right, and then we have to measure their performance of those responsibility centers, right? What are the items, which items are under manager's control, right? And then we compare them with budgeted and actual, right? So preparing timely performance reports, and then you can compare actual amount with the budgeted amount. So this is an example of a responsibility report. It is given on page number 406, exhibit 9.2, about a Panther holding company, right? If you see here again how this is divided. What is a controllable expenses? This is for a furniture manufacturing division, right? What is furniture manufacturing division? What is the level of the furniture manufacturing division? This one here, second level, right? This one. What is happening here, right? That it is prepared, right, for furniture manufacturing division. Now you see this one. Now for a furniture manufacturing division, what is happening? These are the controllable expenses in furniture manufacturing: administrative expense, company's president's salaries, Wilson Carpet Company and Selma Sofa Corporations, and Tables Incorporated, right? Again, you just need to look at the organization structure here. See, this is Table Incorporated. This is part of this business, right? So Table, Selma and Wilson Carpet, this one. So separately, now it's if you see here in this report which I have shown you, you see Table Incorporated, just one line item which says it is unfavorable. So let's say we are not looking at other, just look at one only. This is Selma Sofa, this is other company. Let's look at a one variable which is unfavorable. Now again, if it is not clear, so we further break it down to this Table Incorporated. What are the controllable cost in this company, right, in this business or this responsibility center, which is a table incorporated. So these are the controllable costs in table incorporated, right? So what are in the table incorporated, right? This one, we have sales department, production department, planning and accounting department, right? So if we go back to our report here for table incorporated, this one, see administrative division expense, department manager salary, sales department, production department cost, planning department cost, accounting department costs, right? So if we look at them, we can find out that, you know, this is how it becomes an unfavorable, right? So we further break down this table incorporated into these items. These are all cost which controllable cost under this responsibility center. So this 2650, which is unfavorable, how it came? It came through these different variances, right? This is favorable, this is unfavorable, this one is unfavorable, this is favorable, this is unfavorable, this is unfavorable. Planning department is 2200 is unfavorable, which is a huge amount, 2200, right? So 2650, this is the detail of this 2650 under this report, right? You compare budget with actual and variance, is it a favorable or unfavorable? Then we continue with the same example, right, on the next slide. See, if you look at the production department here, now in the previous slide we find out the production department has where is production department, sorry, yes, from here you can see here production department, let's say 250, right? So if you take a one from them, anyone, production department or planning, let's say we take next level, right, which is this one, right, production department. So what is the detail of a production department? Again, if not clear, you need to go back, look at the hierarchy. Furniture department, we started to break down the variance from here to tables. From tables we put the variance reports based on each department. Then we find out, okay, next one is after table we look at this one, production department, right, which is 250. Further went down to this department, right, into the production department. Here it is just a one line item, 250. We don't know what is the detail. When you break up, when you prepare another responsibility report for production department, you'll find out. Here it will show you more detail, right, that in this production departments, these are all controllable costs, right? Cutting department, assembly and finishing. So more detail of this 250. So we are going down to more responsibility centers, right? And then the last level, which is again go back, right, to these departments. After now we go back to this cutting, assembly and finishing department, right? We are digging it down to the last level to find out the responsibility, right, because it will help us for our performance evaluation. So here now you look at it, okay, in assembly department they have unfavorable, this is less, so this is unfavorable, so this is 100. So what is the detail of this 150? Unfavorable in the finishing department, right? Wages expense were favorable, direct material unfavorable, supplies unfavorable. So this one. So now manager can make a decision why they are unfavorable. What is the reason for unfavorable material variance, right? Why did we use a more material, right? What are the reasons? Again, we can go back and even break it further into for a material usage and material price variance. Remember, this is what we have studied in previous chapter. Direct material variance can be further further classified or further broken into material price variance and material usage variance. So this is what we call it responsibility reports. So now you have seen that how we started from top until we reach the bottom and see what are the responsibilities, right? We started from here, it was just a one line item, then we moved to the table, then we moved to the production department, then we moved to let's say the finishing or assembly department or the cutting department, right? So this is how we prepared our final report, finishing department, right? So now based on this one, everyone can see what went wrong. A supervisor of a finishing department should explain why he has unfavorable variance to his production manager, because then production manager can explain to the next level of responsibilities. So now we can break down up to a lower level and we can move now to responsibility reports. Basically this is how these costs are presented in an income statement format: sales minus variable expenses, right? Which we get it from here, sales minus variable expense, we get it to contribution margin minus fixed costs, right? We get our net income. This is a contribution margin format income statement, and with this one management can focus on the concept, we call it management by exceptions. They can look at some variables, let's say any variable which is more than 5,000 or 2,000, if it is unfavorable by that amount, then they can further investigate, not to look at each and every variable. This is what the concept, we call it management by exception, right? That the amount of details varies basically because of level in an organization, right? A department manager may receive a detailed report, or a store manager may receive summarized information, and then based on that one you can see what actions need to be done, what are the amount of details which varies according to level in organization. So upper management does not look at an error in, let's say, a finishing department in our example, right? So what a vice president of operation, he may receive a summarized information from each unit, not the detailed one. So and that's why we have a very important concept of controllability in an organization, right? Now controllability concept is very important for effective responsibility accounting systems. Now manager should be responsible, or he should be evaluated based only on revenues or costs which they control, right? If they are in control, then they are held accountable. But if for example something is not clear, right? Sometimes control is not absolute, right? So usually managers are not responsible, they are usually held responsible for items which they have a predominant rather than an absolute control. Okay, so basically what you need to make sure that it's absolute control means they have 100% control on those items, which is practically sometimes not possible. So they have mostly or predominantly they are the one who are in the control. So then manager should be held accountable for those revenues or costs. Now qualitative reporting, important for responsibility accounting, that if you want to get maximum benefit from qualitative reporting, then you need to have those reports available on time, regularly issued statements every month, every quarter, right? They should be simple so that they are understandable to all managers, right? And compare budgeted with actual amount of controllable items. If this criteria is there, then we'll have a good quality responsibility accounting system. The last item is the performance measurement of the managers, right? If we have a cost center, you can, for example, how the manager of a cost center will be evaluated by controlling the cost or quantity and quality of a service. If it is improving, so you can evaluate his performance. Manager for a profit center is responsible for a profitability he is generating, and investment center manager is responsible for investment center. He is responsible for profit as well as making investment decision. So how we will evaluate the performance of this manager is through the measurement of return on investment or residual income. These two topics we'll study in the next section. So this is clear. Cost center manager can be evaluated by cost control, how much cost he has reduced or how much quantity and quality of our services has been improved. Profit center manager is responsible for the profitability, what are the targets of profits, if he have achieved or not. Investment center manager is responsible for his investment center manager can be evaluated based on return on investment and residual income. How to calculate these, we'll see it in the next lecture. Thank you very much. If you have any question, feel free to send me an email. I'll be there happily to responding to your questions. Thank you very much. Have a nice day.